Thank you. Hopefully you can see me and my slides. And assuming you can, I'll make a start. So first of all, thank you for those still listening at 7 o'clock for hanging on for me in the last slot to hear about Triple Point Energy Transition PLC. My name's Jonathan Hick and I'm the fund manager of Tent. And I work at Triple Point alongside 11 energy specialists in our dedicated energy team. And all of the professionals in our team have a significant experience of energy infrastructure transactions. Energy is all that we focus on. Our team sits as part of a wider group of over 200 professionals at Triple Point, where we've been making investments that have had an impact for over 17 years. We began back in 2005 financing ambulances for NHS trusts, and since then we have grown to manage over £3 billion of assets across 5 different investment strategies. Impact and sustainability have remained at the heart of that growth, whether that's through our social housing REIT financing affordable homes for people with care needs, or our digital infrastructure fund, investing in data centres powered solely by renewable power. But today I will, of course, be talking you through what I think is the most exciting strategy that we run in energy and talking about how we're investing to get to net zero. So we consider that investing in the energy transition represents one of the biggest investment opportunities for investors over the next 3 decades as we attempt to reduce our emissions in line with net zero by 2050. But it's worth starting by saying that net zero isn't a choice anymore. The UK government has passed legislation to mandate net zero within a 2050 timeline and has set ambitions, such as decarbonisation of the power sector by 2035, that are significantly ahead of that. This has cross-party support, and even though it's worth acknowledging there is not yet, unfortunately, a clear enough roadmap to get us there, the direction of travel is clear. And so from an investor's perspective, that clarity in terms of where the end goal is evident. And that isn't something I think you're able to say in respect of other policy areas or economic sectors. And the scale of the task, the significant transformation of almost every facet of our economy, is what makes this such a compelling opportunity. At the same time, that considerable reworking of the energy system is taking place. Demand for energy is increasing rapidly. That is driven by a range of factors, including population growth, increased electrification, and increased digital penetration. So I sort of liken it to like trying to change the engine of your car while still driving it. We can't just stop what we're doing. We need to keep moving forward as an economy. And that means that, with energy demand growing, that's really important. But at the same time, we can't go forward with the same energy system that we've relied upon for so long. And so that is ultimately at the heart of the energy transition. That balance between getting to net zero as soon as possible while still enabling the energy system to be the backbone of our economy. So that's the challenge of the energy transition. And what does it look like in practice and how do we get there? Well, we think there's 3 main parts to it. First of all, probably the easiest one for everyone's familiar with, we need more renewable energy. We consider the core of a future net zero ready energy system is more renewables. And in the UK, as the previous presenter mentioned, wind will be the backbone given our fantastic natural wind resources in our island. But solar and hydro and other technologies are also important parts of that. The second thing is to make sure that renewable energy is available when it's required, not just when the wind happens to blow in Scotland or the sun shines in the south of England. Last year, that didn't really happen, actually. Enough energy was lost via curtailment from wind alone to power 1 million homes in the UK for a year. At a time when we are considering the prospect of potentially blackouts in early 2023, and when many are facing fuel poverty with high bills, that is an issue we really need to get to grips with and fix. And finally, we need to improve energy efficiency. 54% of energy is lost before it ever reaches the end user. And as energy becomes a scarce and expensive resource, we need to consider demand-side actions and efficiencies to reduce the overall demand for energy. So in summary, to get to net zero, we need to address the challenge across the whole energy sector, from upstream, where power is generated, to downstream, where it's consumed. And this is what we've set out as a core of our investment thesis. So we take a holistic approach that asks, how do we get to net zero across every facet of our energy system? We don't think you can just take a specific area, perhaps even a specific technology within a specific area, and just assume that you're doing enough. We think that multi-technology, multi-asset strategy shouldn't just be done for the sake of it. There needs to be real intentionality and a laser-like focus on how each investment contributes to the energy transition as part of a broader vision. So starting on the left-hand side with distributed generation, the first area that we focus on, we want to help move away from centralized fossil fuel generation, such as coal and gas historically in the United Kingdom, to decentralized renewables located wherever possible closer to centers of demand, which reduces transmission losses and energy wastage. Specifically within this area, we know there are lots of really established funds doing lots of great work, specializing particularly in wind and solar. I think we're really trying to do something a bit different. We're trying to focus on those technologies that investors wouldn't otherwise have exposure to, but we think can play a really vital role in getting to net zero. And hopefully when I walk you through some investments we've made in our portfolio, you'll see what I mean. The second stage then is storage and transmission, which is how we get the energy generated to consumers efficiently and at the right time and frequency. The move to a more renewable energy system means more intermittency, and so balancing that system becomes ever more important. Right now, we think that energy storage is a really exciting area, and we'll talk about how we're investing in that space with an example of one of our storage investments shortly. The final area is on-site generation and efficient consumption, and we think very strongly this is the most overlooked area of the transition. This kind of captures two main separate focuses. The first is providing energy requirement of a business or a customer on site. It could be rooftop solar or heat networks or on-site combined heat and power. The second is reducing the absolute level of demand behind the meter, for example, LED lighting or more efficient equipment. We are seeing a significant pipeline in this area as businesses seek to reduce their energy bills, and as concerns around blackouts in January increase, a focus on energy security, particularly with certain geopolitical events, have become apparent for many industrial heavy users of energy. So these three areas combine what we refer to as a holistic approach from generation to consumption, and we think that this brings three main advantages to our shareholders. Firstly, we think this system-wide approach provides our investors with an interesting mix of risk and return characteristics and strong diversification. Secondly, by focus on those more niche technologies, we haven't yet made any distributed wind or solar investments, for example, we face less competition for deals and thus can offer more interesting returns. And finally, from an impact perspective, we think that for investors seeking to really drive progress towards net zero, backing an investment strategy where that is the central premise, and which is investing in some of the less well-known but just as important parts of the sector, we think is really important. So hopefully that gives you a sense of the investment opportunity and our investment thesis. What I thought I'd talk to you about next is Tent itself and give a little background on the trust. So we're a pretty young investment trust. We IPO'd 2 years ago, and we aim to deliver a sort of 7 to 8% return to our investors and a 5.5p dividend. In that time, we've built up a portfolio of 17 assets spread across the three thematic areas that I set out previously. You could already see from just initial proceeds raised at IPO that diversification is really hardwired into the portfolio across different counterparties, technologies, and capital structure. And I'll come on to talk about this in more depth on the next slide, because I would say this is the most important thing that people investing in energy should be thinking about in their portfolio. And finally, the last externally audited results, showed NAV growth, and every asset in our portfolio outperformed and was ahead of budget, with no exceptions in that previous financial year. Half of the income that we receive is contractually linked to RPI, and now that our capital is fully committed, we have a full year of income to cover our dividend payments to shareholders. The pipeline is strong and spread across a range of opportunities such as EV charging, energy storage, combined heat and power, and energy from waste. So coming back to diversification, we really do see this as being embedded into every aspect of our portfolio. And I think the first thing to really understand is that we sell so much more than just electricity. Whilst that is an attractive market to be in, especially at the moment, by investing across the whole system, not just part of it, we invest in assets that sell heat, that sell frequency response, that sell reserve power, and energy efficiency as a service. By selling more than one product, we ensure earnings are not as volatile as the general electricity wholesale market and offer investors reduced volatility. We are currently invested across 4 technologies and have a pipeline of many more, again giving further diversification to investors. And we sell the energy in its various forms to a range of counterparties, reducing our exposure to any one entity or type of entity. Our investments are at a mixed stage of development, construction and operation, and the trust is mandated now to invest in the UK and in Europe. So diversification is inbuilt into the portfolio, and as I said before, we're focusing on these sort of unsung hero technologies, if you like, outside of large offshore wind and utility scale solar, which dominate many other London investment trusts. So we think Tent is a diverse portfolio of something a little bit different, and I think therefore fits alongside some of those more pure play trusts in investors' portfolios. On the next few slides, I'm going to talk to you about and do a bit of a deep dive into some of the investments in our portfolio. And starting off at the start, our first part of our mandate, investing in renewable generation, I'll talk you through our hydro investments. So we own 9 run-of-river hydroelectric assets located on the west coast of Scotland. These assets have very long asset lives, typically up to 45 years, and have fairly limited ongoing maintenance. The way they work is that water is captured at the intake and flows underground through a penstock to power a turbine where electricity is generated. So actually you go there and it's a little bit disappointing because most of it's underground, as you can sort of see from the pictures there. But in terms of what those really important assets produce, they produce electricity, particularly at times of peak demand around winter here in the UK, and that's obviously really important for the energy balance. And we receive 2 income streams from the energy generated. First, through a government subsidy, the feed-in tariff that was mentioned previously, we get a subsidy for every unit of energy that is generated. And the second is that we then sell that energy to companies such as EDF or E.ON. Now, it's worth noting with the feed-in tariff that you effectively benefit from a price floor, the export tariff, that ensures a minimum price of energy generated. And I always think it's interesting to remind investors that about 2.5 years ago, there were negative power prices here in the UK, which is quite hard to think of now at these record high points, but it is ultimately quite volatile, and having a sort of price floor, as you have with the export tariff, which is linked to RPI, is really important. So both of those revenue streams indeed are linked with RPI, and so that's why in this portfolio, around about 97% of our income is effectively backed by the government, contractually linked, and with units that go up in line with the retail price index. The cost base is pretty fixed, and typically also moves in line with RPI, which gives you stable margins. And we've set out here a sort of high-level example on an indicative basis of what inflation can do to NAV of that particular investment. And illustratively, you can see that it lifts 100 basis points extra, more than we forecast on inflation, can lead to up to a 10% increase in NAV. Our long-term assumptions are around 3%, so we think that's quite conservative in the current market. Over on the next slide, there's that second segment, which is storage and transmission. And here I'm going to talk to you about a storage asset investment that we've made. So we've made a commitment to build out a portfolio of 4 energy storage assets spread across the UK, with an installed capacity of around 110 megawatts, producing 160 megawatt hours of energy. Storage assets use equipment from tier 1 manufacturers, the first of which was actually commissioned on Sunday a couple of days ago. Now, storage assets derive revenues from a range of different sources. They provide ancillary services such as dynamic containment, dynamic regulation, dynamic moderation, which keep the system frequency at around 50 hertz, which is an important part of any storage business plan. Longer term, we see those assets taking advantage of the deep wholesale markets that have existed in the UK for many decades, such as intraday and day ahead. And finally, long-term contracted income through the capacity market, which is effectively being available to provide capacity to the system to keep the lights on, is further revenue for our assets. Given the complexity of trading these batteries and working out which revenue stream at a given point in time is best, we partner with Statkraft, one of Europe's largest leading energy companies, to optimize battery and derive revenues for the assets. And again, the cost base is quite stable, and the largest cost, which is with the off-taker, is variable in line with revenues. Moving on then to the third and final segment of our investment thesis. We consider investments into on-site generation and demand reduction, and this is by far the fastest growing segment of our opportunity set. One of our investees, Spark Steam, is an energy centre in Teesside, which provides both heat and power to leading agricultural growers. Heat is generated through a gas turbine, with the heat stored in the form of water and pumped into glass houses to ripen the fruit, tomatoes in this case, over the growing season. Spark Steam receives an availability payment. It increases with RPI for making the heat available to the grower, so you're not taking volume risk there. The electricity produced is then sold to 3 counterparties. Firstly, to the on-site grower, the tomato grower, which uses a small amount of electricity as well as the heat in its glass houses. But the majority is sold via a power purchase agreement to a nearby, across the road actually, food manufacturing business. And then the final source of revenue is selling energy back to the grid. So what you've got there is 4 different sources of income from 3 different counterparties, underpinned by availability revenues, which provides an attractive and diverse income story just in that one asset alone. And 70% of that income is increasing contractually in line with RPI. We are seeing lots of demand now for on-site generation, and we note here that the grower has made significant savings, which benefit, as a function of the CHP energy centres. Another investment that we've made, I've not got a slide on this one, is to exhibit our work in the same segment, is investing in LED lighting at a large logistics business. And this represents, again, a different source of income for our shareholders that isn't linked to energy generation or production. We estimate that the LEDs are saving the business 20% off their energy bills and, of course, reducing demand for energy. So I want to use, I guess, the remaining time I have to talk about how our portfolio is set up to face some of the key headwinds in this space. The high energy prices that we've seen are driving a lot of policy interest in energy markets. And I think it's fair to say all investors should be considering how their portfolio is set up in the face of some of the proposed changes. Before we get into the policy challenges facing energy investments, I just wanted to touch on how TENT will fare in a high energy inflation environment, which is, again, a key headwind that we find ourselves in, and which is impacting many companies and trusts in the UK. In short, TENT benefits from inflation, given that 50% of income grows contractually in line with RPI. Other revenue streams, such as wholesale power market income, typically increase in an inflationary environment, and indeed at the moment, power prices being the key driver of inflation. And so we consider them to be correlated with inflation. Indeed, at the present time, as I said, energy is kind of the key driver there. And all of our investments are underpinned by long-term contracts, at least 10 years for those assets. This slide then summarizes, on the next page, we summarize how our portfolio sort of compares for a dedicated single asset technology trust, which just sells one product, electricity, and just relies on one technology. TENT sells multiple products across a range of different technologies. And so I think in a highly regulated sector, and I'm going to come on to talk about some of those regulatory headwinds, we think this is really important. And I think the next slide illustrates why we think this is more relevant than it's ever been before. So there's a couple of material changes that investors in this space, I'm sure, will be aware of. The first is the review of energy market arrangements, or REMA. In October 2022, the government closed the consultation on REMA, and what REMA is potentially transformational change to the way energy markets in the UK work, and it seeks to examine whether, for example, we should move to geographic pricing or regional pricing, whether we should make changes to the short-run marginal cost approach to pricing electricity that currently exists, and whether there should be changes to the capacity market, amongst many other things. And we have been giving quite a bit of thought to what that might do and what the impact on our trust would be and how we're set up to deal with those headwinds. And so we've given some thought here to regional pricing. This would have been, for example, and it is still very early stage and no one knows for sure how this pans out, but one such option is that you split the country into effectively 3 different regions for pricing. But it might be Scotland, north of England and the south. Prices would then vary in part by the level of generation and demand in that region. And so in some region, for example, Scotland, you could find yourself in a scenario where there is significantly more generation relative to demand, given the offshore wind fleet is concentrated up there. Equally, assets in the south might be able to derive a higher price through being closer to centres of demand. Now, some leading power market researchers have concluded that geographic pricing arrangements could reduce income by up to 25% per annum for some technologies in some locations. And depending on when that's implemented and the average project life in investment trust, this could impact NAVs by up to 15% for a pure play generation investment trust. Because TENT isn't focused on a specific technology or even generation assets, the worst case we've calculated is up to 6% in an extreme scenario, which is lower than others. And particularly, we think that on-site generation element, which is our key area of focus, would not be expected to be materially impacted. We've also talked over in this session about, on the previous presentation, about a price cap and whether it's a windfall tax or a cost plus revenue cap. The Energy Prices Bill does give the Secretary of State a lot of power to essentially cap prices that can be received. And Europe's gone ahead at 180 euros per megawatt hour. We've seen some other investment trusts indicate their exposure as being up to 7% of NAV if the cap is in line with European level. And again, because of that diversification, we're seeing our impact be significantly lower than that. Of course, this is all illustrative, and no doubt the Secretary of State will surprise us by doing something completely different. But I think the broader point to make is that the value of a diversified portfolio of assets in the energy sector by energy specialists means that you can ride out these potential changes to the market as we get towards net zero. And we think particularly having on-site and behind-the-meter assets, LED lights, for example, aren't going to be significantly impacted by changes to the way electricity is priced on the wholesale market. And a final and I guess more obvious benefit to the diversified portfolio approach is that it involves yield compression and basically overbidding. as it's possible to target new and emerging sectors as part of energy transition, not just the mature ones, which can lead to more attractive risk-adjusted returns by getting into those spaces early. So we're privileged to be in a really exciting sector, and we have a really well-balanced pipeline across our 3 target segments. We're really seeing at the moment a real trend for corporates looking for on-site demand and on-site generation and demand reduction, as well as demand for flexible generation assets such as batteries. We have a specific strategy of not building up a huge team of technical and operational professionals internally, and we prefer to back the best management teams in a given sector to operate and manage the assets. It may be that the best management team in town isn't the one internally, and we think that makes sense to acknowledge that and have the freedom to work with best-in-class management teams. And we think that's different from the majority of other investment trusts and approaches out there. It's just good to have a slightly different exposure to give you access to different management teams. So to wrap up, you'll be pleased to know slightly early on a Tuesday evening, there's really 3 relevant points I hope you'll take away with Tent. The first is that we think at a time of high energy prices, potential blackouts and scarcity of energy, it's really important to invest holistically across the energy system to get to net zero. We're pleased to be reducing consumer bills, improving energy resilience, and speeding the transition to net zero. And we do that in a way that minimizes risk to our investors through a high level of diversification by assets, by geography, by stage of development, and by revenue counterparty. And by focusing on those more niche areas, such as hydro rather than offshore wind, for example, we can focus on areas with reduced yield compression and more attractive risk-adjusted return characteristics to investors. So thank you for sticking around till 7:15 to listen to me on a Tuesday evening, and obviously happy to conclude my remarks there and happy to take any questions that may be in the system.
Yeah, absolutely. I know we're quite used to people sticking around till 7:30, and we've seen no drop off through your presentation.
Oh,
so,
good.
I don't think there's anything that people are particularly rushing to do. So yeah, let's get into these questions. So again, just to go back quickly to the UK regulatory thing, you mentioned the 180 euros on the continent where you've got this cap on producers, right, selling their electricity. I don't think, but so in the UK, we're now going to have we've got the cap at the bills end, haven't we? Where I mean, surely there is no room to do both. That would be sort of squeezing at both ends, wouldn't it? I mean, I'm just trying to work this out.
Yeah, it's quite complex. I mean, effectively, what's driving the higher price to you and me paying our electricity bill is the high gas prices in the market, right? And so I think the way I very briefly mentioned this short-run marginal cost, which sounds very nerdy in energy speak, but basically if gas is expensive, it sets the price for all generations. So even if I'm a solar plant generating energy and I've not got a very high input cost, I mean, I haven't got any input cost, it's the sunshine. Ultimately, if gas is going for a very high rate because of war in Ukraine, etc., then I can charge a higher rate of solar. And so what the government's saying is, well, how do I separate that? How do I ensure, I'm trying to convince people to have a wind turbine near a house or believe in more solar. So should people be feeling the benefits of this supposedly cheap renewables that we always hear is the cheapest form of energy? And the answer is absolutely they should, right? And despite managing a fund that owns generation assets, I do feel, the profits that we're making are significantly higher than any reasonable base case. And it's not unreasonable for, in my view, some form of windfall tax. To my mind, that would be a better mechanism because it encourages reinvestment into energy transition rather than arbitrarily capping revenues. I think that's entirely appropriate. So you do need both, actually, to kind of both drive cheaper pricing in and to mitigate the impact of the gas high prices that we've seen through no fault of our own in broader geopolitics. So I think both are fair.
Yeah. Which, and as you've touched upon, it's that 40% of our electricity roughly at the moment is gas generated, isn't it? Right. So as the gas prices go up, and is that sort of proportionate then? Because I know the two are, you said that the two are kind of coupled. As gas prices go up, so does the kind of standard energy price. Is there a mechanism, as we bring in more renewables, as is the government's ambition? We hear about, ambitious stuff for wind. The proportion of our electricity from gas goes down. Do the market mechanisms at the moment, would they then bring the price down with it? that makes sense.
They would a little, but if you still got gas on the system, then at various it will depend on the time of day is the simple answer. But yes, but if you still got gas in the system, and if gas still sets the price, then at those times, if you're generating when there's gas is setting the price, you'll be able to make a super profit. So I think that for sure, gas is a separation of the gas, separating gas and renewable energy prices. I think I can see why the government's attracted to it. And again, the previous speaker spoke about CFDs. It was mooted that they might move everyone to a contract for difference, where there's a sort of fixed price for renewables. That would be one way to do it. But I think legally, it's quite a challenging thing to do. So I think you will start to see the price come down as more renewables enter the system. I think obviously the government's trying to accelerate that to happen even more quickly. What it needs to do is make sure these changes in such a way that don't discourage investment in the UK, right? I mean, we all want international investors to invest in our energy system. And if Europe's capping it at 180 and we cap the revenues at 60, guess where capital's going to flow? So I think it's really important that it's done in a way that is cognizant of the need to get, I think it's something like £50 billion a year of investment to get to net zero per year in the UK.
And there's a question that's come through about hydropower. Is that something you're enthusiastic about? And is it something that the UK is well equipped for?
I'm extremely enthusiastic about hydropower, despite sort of previously condescending what they look like when you turn up there after a long flight from London. But look, there's about 400 run-of-river hydro sites in the UK, and to be honest, we don't think they yet work on a subsidy-free basis. They do in other territories such as Scandinavia, for example. So I think probably in terms of run-of-river, I don't expect to see too much more there unless they're able to kind of bid into a subsidy scheme like Contracts for Difference or any potential future ones. There is opportunity, albeit again not a high volume of opportunity, in pumped storage. People talk about battery energy storage, lithium-ion batteries as a brand new concept, but pumped storage has been around for decades. And so that's effectively what's been providing flexibility previously. I think there's opportunities and there are plans for more pumped storage facilities. I don't see significant growth in hydro in the UK, but obviously we've got a mandate to invest in Europe, and we certainly see in certain territories, such as Scandinavia, hydroelectric power being a really interesting opportunity there.
Another questioner has asked if you're affected by soaring lithium prices.
I think anyone investing in batteries is dealing with soaring lithium prices and more broadly cost inflation across a range of other areas. I mean, transformers, which are the things that kind of adjust the voltage from your plant to the voltage on the grid. There's a long lead time for those of about 3 years in some cases, and the costs have gone up significantly. So we're dealing with that across a broader range of investment areas, to be honest with you. What you're also seeing, of course, is higher prices that from a returns perspective is somewhat offsetting that. Particularly in terms of lithium, clearly the demand there is being principally driven by EVs. That is where most of the EV is going to go, but so lithium is going to go rather than stationary storage. But I think for us, I guess, again, we're benefiting from higher revenues for battery storage. There's been record revenues achieved last year. And to some extent, the revenue case is offsetting the slightly higher capex costs in that particular segment.
Mm-hmm. That just ties in quite nicely to this next question. You mentioned that kind of rush for electrification. The government's very enthusiastic about electric cars, electric trains, electric vans, all of this. There are some people, though, that say that we've been too quick to overlook what they call sort of green hydrogen. The question is asked about this: is green hydrogen on your radar? And, at risk of kind of getting you to kind of teach some of us, like, what exactly? Because isn't there this idea that somehow this links up to the existing gas network?
Oh God!
And you can,
right.
At the risk of getting you to play teacher, what exactly is green hydrogen? How excited should we be about it?
I think it's fair to say this is, I would say, a very hotly debated topic. Some people will tell you that this is a scheme pumped by the oil majors to enable them to take advantage of existing infrastructure and their existing operations. I probably have a slightly more charitable view that green hydrogen, there's no silver bullet, first of all, in getting to net zero, full stop. I think hydrogen can play an important role in decarbonising certain areas where electric cells don't work. So heavy goods vehicles, for example, don't really work with batteries, for example. You could see potentially it working in short haul aviation. You could see it certainly in decarbonising shipping, which is a really tricky one to decarbonise. So in certain settings, I do believe hydrogen has a really important role to play. Green hydrogen is where the hydrogen that you make comes from, funny enough, green power. So that might be an electrolyzer connected to a wind turbine, connected to a solar farm. The power comes from that renewable generation and turns into hydrogen. But you've got grey hydrogen, which I think is gas. You've got pink hydrogen, believe it or not, where the nuclear power is making hydrogen. So you've got all sorts of shades of hydrogen, but the end product is ultimately used as a fuel. I don't see it being relevant to road vehicles. I don't really see it being relevant personally to homes. I don't think we'll be sat here in 20 years with hydrogen boilers. Personally, I think you can get currently with the existing gas transmission network about 20% blend of hydrogen in there. First of all, it's not really making a big difference, is it, in terms of reducing emissions? And to actually get the whole thing to be 100% hydrogen, you need billions and billions of pounds. Heat pumps, I think, are a better solution to that particular problem, despite poorly insulated housing stock in the UK. But green hydrogen has a really important role to play. So yes, it is on our radar. And in fact, we're looking at the moment in two opportunities to invest in hydrogen electrolyzers connected to green generation, which will enable us to produce green hydrogen and sell them through an offtake or fixed price contract linked to inflation to someone who would use that in their business. So it is a really interesting area. I think the previous speaker mentioned this as well. We see really good opportunities here. And the government has actually put in place a pretty strong policy framework to enable investors in the UK to take advantage of those opportunities.
That's good. And speaking of frameworks, obviously you mentioned investing across Europe, that you've got the mandate to do that. You know, there's a lot going on with this, but I think ideally, what you're looking for is this investment framework where there's sensible plans to get renewables, and big investors can put up the capital and know that the support's there for them to get it to the market. So with that in mind, are there any countries within Europe that you think are, best of class that we should be looking at from a kind of, also just from a policy regulatory angle,
Look, I think the UK is actually pretty good, right? I don't think we should be, doing ourselves down. I think each country has its own slightly different arrangements, and some might be good for renewables but less good for storage. We're very strong for sort of storage and those ancillary revenue streams that I talked about earlier. That's a real credit to the electricity system operator and Ofgem. I think there's other areas where I think, particularly around this revenue cap stuff, that is creating policy uncertainty, and clearly REMA, as I mentioned, is also creating certainty. But look, I think broadly governments across Europe are supportive. I would say, Ireland in particular, I would highlight as being a very attractive opportunity. It's got some really ambitious targets for renewable penetration. It's got some really ambitious targets, therefore, or requirements, for battery storage, particularly given the lack of interconnection, which is the connections between Ireland and the UK and mainland Europe. So they've got to keep all the power they create on the island. So I think Ireland in particular is particularly interesting at the moment, but I think all EU countries are actually pretty well placed given recent policy and are attractive to investors. I think the UK continues to be, as long as it doesn't do something slightly short-termist, shall we say, on revenue caps or windfall taxes that discourages investment and makes it go to other geographies.
Yes, yeah. So when we hear about all these ambitious goals, sort of triple wind in 10 years or whatever, we shouldn't be too cynical about them.
We shouldn't be too cynical. The biggest challenge to energy transition, says everyone I think who I've bumped into in the sector, is actually grid connections. That is by far the biggest challenge. And it's the one that is a bit techie and a bit nerdy, and so people don't like to talk about as much, frankly, but it is by far the biggest challenge. And there's this sort of, it takes you, I think, a year to sort of get a wind turbine to connect it up and to, from production in a factory to sort of plugging it in. It takes 7 years to get planning on typically for an onshore wind turbine. And that's if you can get a grid connection, because as I mentioned, they're in very short supply. We've seen a lot of pipeline with people offered connection dates. That's the date to connect their solar farm to the grid, being moved from 2024 to 2031. How can you bring up solar energy or wind energy onto the system if effectively a national grid is, to put it very crudely, saying, sorry, the transmission networks are full capacity, you can't plug in. And then you've got returns being pushed back for many years for investors. That's a real challenge. And if you're just a certain technology investor or just solar, just wind, you might be particularly impacted by that. We see that behind the meter, that the on-site stuff that I was talking about, well, that's less of a risk. We see that as being a really important part of that. But the biggest challenge to get into net zero, for sure, is lack of grid capacity in the UK. And that's what REMA's sort of trying to solve to a large extent.
Excellent. Well, Jonathan, I think it's been a real privilege here to get your expertise. But it strikes me that you've probably gone in the last year. You would have gone from someone who when you told taxi drivers what you did, they just kind of shrugged it off, to now all of a sudden you're just bombarded with questions left, right, and centre about energy prices and gas storage, and
for sure, energy has suddenly become a front page thing, which is often it's not necessarily a good thing, because it often encourages policymakers to make short-term decisions. But it's certainly a incredibly interesting time to be in the energy transition sector, and both the short-term drivers and long-term drivers make this a really interesting place to invest and to work in.
Definitely, and I think it's been really interesting for our viewers to be able to put some of those questions to you, and to really evaluate this as an investment opportunity. Because it's something that's affecting all of us, but there are clearly returns to be made if sensible decisions are made out there. So Jonathan, thank you very much. So we will let you head off and do whatever you had planned at 7:30.
Nothing that exciting, unfortunately, but thank you so much for having me. Have a good evening.
Thank you, Jonathan.